There's a lot of confusion about the treatment of working capital when selling a business. Working capital features in business valuations, sale price allocations, and the sale adjustment calculations, to name just a few. Most business owners and even some business advisors don't understand how working capital can impact on the goodwill of a business and how it is accounted for in the context of a sale. Consequences of not knowing can be dramatic, with owners giving away substantial value without even realising it. This topic is too broad and too complex to cover in a single video, so we've broken it into a series of 3 videos so each aspect can be covered properly. This is video 3 of a 3-video series specifically on working capital in the context of the sale of a business. The aim being to clear up any misconceptions and explain how optimising working capital can benefit exiting owners. In this video, we talk about the key working capital elements to see how each should be accounted for. We're going to cover inventory, including stock in transit, trade debtors, trade creditors, cash. Yes, cash is part of working capital, so how should it be treated? And employee entitlements. So now in this 3rd video in the series, let's look at some key working capital components and discuss how each should be accounted for. Firstly, let's look at inventory. This is usually sold with the business and may be subject to a stock take at completion. Inventory is usually sold regardless of whether the transaction is an asset sale or a share sale. In other words, a sale of assets from inside the vendor entity, be it a trust or a company or some other partnership, for example, or if it's the sale of company shares, where all assets are normally included, including of course inventory. So what about stock in transit? Well, that's clearly part of inventory, just as raw materials, work in progress and finished goods are. Stock in transit is generally included as part of working capital. However, there are 2 elements to this. One is the stock on the asset side and the other is the creditor on the liability side. So the stock on the asset side and the creditor on the liability side need to be considered individually. When does the stock order become stock in transit? Well, stock needs to be included as part of working capital when it commences to be at the owner's risk. If it is a mere order to be fulfilled and nothing more, it doesn't get included in the working capital. The key point of recognition of stock in transit is the point at which risk passes to the business owner. When the risk passes to the owner, it becomes stock, or in this case, stock in transit. Does at risk coincide with when title passes? It does in most cases, but it is safer to use at risk, as title can sometimes lag depending on the terms of trade. On the payables side, any stock that is both at risk and unpaid for should also be included in the trade creditors as part of the working capital. So until the stock's paid for, being a creditor means it will net off against the stock in transit on the other side of the net working capital calculation. So the net of those 2 would be 0. But if the stock has been paid for, and therefore it won't be on the creditors or the liability side, it will only be on the asset side. And just to throw another variable in, if the stock has been paid for or partly paid for before risk passes, and that before it becomes stock in transit, then that would normally be a prepayment or a deposit. It would then still sit on the asset side of the working capital calculation because it would be in your balance sheet as probably a current asset. Trade debtors. Trade debtors can either be sold with the business or not, in which case the seller will collect the outstanding amounts from their customers direct, and the buyer will not acquire them but will need to allow for funding of an equivalent debtors book balance to build over the first few months that they own the business. Debtors are usually not sold with the business in an asset sale, but usually are sold with the business as part of a share sale or a sale of the company's shares. However, the debtors may be included in the sale when there's a sale of company assets. So it doesn't have to be one way or the other. It depends on the preference of the parties. Here's a question. Why are trade debtors included in the valuation of the business and the sale? One argument to exclude the trade debtors often put forward goes along these lines. The debtors are the result of the vendor's sales for which they are making a profit and will be accruing a tax liability, all while they own the business. So why do they now need to give those debtors away as part of the overall enterprise value when selling? If the business was closing or being sold purely on an asset basis, rather than as a going concern, then this logic might hold true. However, as soon as the business is being valued and sold as a going concern, where the buyer is paying for an expected future cash flow based on a return on investment, then they become entitled to acquire all the assets required to generate the profit, or to include an allowance for them, and also to generate a return on investment factored into the purchase price from day one. So on that basis, either the trade debtors themselves or an allowance for the equivalent amount needs to be provided as part of the overall enterprise value. What if you sell the debtors at face value and the buyer doesn't collect them all after sale? Well, there's often a provision or a retention held in case not all the cash is collected from outstanding debtors that have been transferred. Sometimes they're handed back to the seller to manage if they remain overdue for an extended period, with an adjustment made back to the buyer. Let's look at trade creditors. Well, it's virtually the mirror of the trade debtors situation. They may be either transferred to the new owner and adjusted for, or may be paid out by the seller, just as the case for trade debtors. Either way, the working capital adjustments will account for the difference. Let's look at cash. Why is cash included as part of working capital? Is that included and sold too? Cash is an obvious working capital component, i.e. an asset, but it is usually treated differently. Cash is not normally included with the business sale. Most transactions have the purchase price negotiated on a cash-free, debt-free basis, so cash is specifically excluded. However, some buyers, notably say private equity firms or fund managers, may require adequate cash to be remaining in the business so that no further cash injection is required after takeover. This may only be enough to cover the projected shortfalls until sufficient cash is generated, usually from the trade debtors' receipts, to put the business into the black. And finally, let's look at employee entitlements. These are usually transferred to the new owner or the buyer and adjusted for in their favour to offset the liability that they're taking on. The adjustment is usually tax affected, so the vendor might otherwise have been entitled to, say, a tax deduction if the going rate or the company rate is, say, 30%, then the adjustment in favour of the buyer will be only for 70% of the gross entitlements. And here's a question that's come up regularly. Let's say there's an adjustment mechanism whereby the sale price is adjusted usually down to take into account the liabilities for the employee liabilities that the buyer's taking on at completion. So there's an adjustment for maybe the 70% that we talked about earlier. Now, if that's the case, why is there sometimes, or why is there always, a working capital adjustment component attributed to employee entitlements as well? The question people ask is this a double up? Well, it's not a double up. In fact, the two net each other off. The credit for employee entitlements in the net working capital increases the goodwill component of the business, which effectively offsets the amount that's been adjusted for in the sale and the purchase price to reduce that. So the more credit there is in the working capital, the net working capital is lower, and therefore the goodwill's higher on that side, which is offset by the reduction in the purchase price in the other part of it, normally a transaction contract. On that technical note, we've completed the 3-series video on working capital in the context of business sale. We've covered all aspects of working capital you should need to know when selling your business. We hope you've enjoyed the presentation and have gained valuable insights as to how to best prepare your business's working capital profile for the sale of your business. We look forward to sharing more information about the sale of your business in future. And you can always visit tonybrown.net to see all of the videos we've made available on the topic of selling your business. Bye for now.